Welcome to the Money and Investing Show. This space is all about managing money and kickstarting you into the world of investing and finance. A series of bite-sized episodes designed to simplify and equip you with the tools on how to get you started, along with some tips and tricks for those already investing. Stay tuned for today's episode with your host, Dale.
Hey everyone, and welcome back to another episode. I'm glad you all made it through the episode about risk, and I know we're covering a lot, and you're probably just like, hey Dale, I really just want to know how to find and buy a stock, and I promise we will get to this part, but it's super important that we build up some of the fundamentals first before we just dive in and start buying shares. So now that you understand a little bit more about risk, you can start to think about what kind of investment styles will work best for you. Now, as we go through the different investing styles, you may find that there's no one size fits all, and you may even find that you like a little bit of a couple of different styles that you want to put into one portfolio, or you may prefer just to stick to one. So first up, we want to have a think about your goals. Everyone has different needs, so you really should determine what yours are. Are you thinking about investing for retirement, or are you looking to make a big purchase in the future? Things like a car or a home, or you could just be investing for something like your child's education. So as you start to narrow that down, that will help you figure out and define your strategy. And to kick things off, the very first decision you have to make is, do you want to be an active or a passive investor? So what do I mean by that? An active investing refers to actively being involved in your stock picking decisions and looking to buy and sell when you think the time is right. Whereas a passive investor is just looking to park their money somewhere and not really need to think about it that often. So generally, passive investments are in the form of things like ETFs or managed funds, where you can leave your money alone and it should just accumulate over time. So this is a great option when first starting out, as you get plenty of exposure to the market without really needing to do a whole lot of research. It's also great for those that don't have the time to research stocks or even the interest for that matter. As I've discussed in other episodes, my first ever trade was an ETF. I bought into the Vanguard MSCI All World Fund, which gave me exposure to stocks all over the world. And as I wasn't really sure where to get started, this gave me a really diversified way to dip my toe into the water. I still hold that stock today, and from the last time I checked, I think it's up almost 80% over 5 years. So that's really good for something that I've just let sit there and never really paid too much attention to in comparison to some of the stocks that I pick as an individual company. Now, passive and active investing don't necessarily need to be mutually exclusive. You can choose to do a little bit of both. I know in my portfolio that started out quite heavily passive, it's gradually become more and more active over the years, but it's still made up of about 30% ETFs to this date. So let's have a look at the other side, and suppose you want to be an active investor and you want to choose your stocks. What are some of the main styles that people choose or can work with? First up, you have value investing, which is probably the one you hear the most about. This is the style Warren Buffett most famously uses, and it is all about trying to pick a stock that is trading below its intrinsic value. In other words, value investors believe that the market often overreacts to good or bad news, so it can go both ways, resulting in a share price that does not reflect the company's long-term fundamentals. Therefore, when a company is oversold, this would offer a buying opportunity. Think of this like a bargain shopper who wants to buy an item but will always wait until it goes on sale before making the purchase. So value investors often spend a lot of time studying things like a company's price to earnings ratios, their free cash flow, discounted future cash flows, and other fundamental markers to decide on a fair value for the company. So value investing is really about a long-term play, and often investors that change strategies halfway through can miss out on the long-term benefits that value investing provides. To give a really basic example, let's say I'm looking at a company to buy, and let's call it Coffee Co. I'm saying that because I have a coffee right in front of me. And I've done all my homework on Coffee Co. and decided that its shares are worth $10 today. A value investor would wait until that company's share price had dropped below $10 before buying shares within that company. Next up, you have growth investors. So growth investors are less concerned with some of the overarching fundamentals that we just spoke about and are really looking to the long-term growth prospects of a company. When looking at growth companies, you should still be able to find trends of a strong earnings and revenue growth, signifying a capacity for future growth expectations, but they're less concerned with those overarching fundamentals. So growth investors will sometimes look at companies that aren't necessarily making profits, but they think will make profits one day into the future. So they're essentially buying the future prospects of the business. Growth stocks are generally less established businesses and can carry more risk. Therefore, the expected returns can often be greater, but also you have the chance of losing money. A downside to growth investing is a lack of dividends. If a company is in growth mode, it often needs capital to sustain its growth, which means there isn't a whole lot left over at the end for dividends. Generally speaking, with growth stock, most of the market views them in the same way, which tends to give them a higher valuation and can create even more risk. To use my example earlier of the Coffee Co., a growth investor would be less worried about what they think Coffee Co. is worth today and more what they think it'll be worth in the future. So for the valuation thinking, it kind of goes to the wayside because they're more worried about what that future price is going to be. So in other words, they wouldn't mind buying the stock at $11 if they think the company is growing fast enough that it will go to $22. That's not to say you won't still do your research and value the company. It's just that you are of the belief that the company will continue to grow and that purchasing share price at the time is of little importance when you're talking about doubling the company's value. Next up, we have traders or day traders, chart traders or algorithmic traders who like to move in and out of positions regularly. Traders are active traders who execute intraday strategies to profit off price changes for a given asset. Trading employs a wide variety of techniques known by what's called technical analysis and different strategies to capitalize on perceived market inefficiencies. Trading generally requires a high degree of self-discipline and objectivity, really, along with a tight set of rules. Generally speaking, if you are working a full-time job, you won't have the time required to employ this type of strategy. There's also a lot of traps you could fall into as a new investor, so I wouldn't really recommend this one when starting out. Up next, I've put this one into a separate category to day and chart trading, as I think it has some merit to new investors or even seasoned investors, and that's what's called momentum or trend trading. And that basically looks at the chart of a stock price movement and assessing the general trend or direction the stock is moving to help ascertain if the stock is in favor. So momentum investors like to go with the flow. They believe winners will keep winning and losers will keep losing. They look to buy stocks experiencing an uptrend, thinking that trend will continue, or sell stocks when they see that trend changes. I often find myself analysing the momentum of stock as part of my buying decisions, but that's not to say it's the only way I pick a stock. It's just really another level of analysis that I might add into that buying decision. And lastly, there is the industry or basket style investing approach, which is where you pick an industry or trend you think is going to take off into the future. So let's use something like buy now, pay later as an example. And you look at the trend and you say, I can really see this taking off, but I don't know which company will be the big winner. And so you invest in a few of them. So you might buy things like Afterpay, ZipPay, Seasel, OpenPay, and I'm sure I'm missing about 7 more of them at this point. But the idea is that 1 or 2 of them will outperform, and even if the others don't, you have still made some great money because the ones that did outperform have far exceeded the losses of the ones that didn't do much. You might also find there's an ETF out there that do this for a specific industry or trend you are looking for, so it's really worthwhile to check out sites like BetaShares or Vanguard to see what's already available. You know, you may think you've got an industry trend, there's a good chance there's an ETF that's already available for that segment. And so that wraps us up for today. As you can see, there is plenty of styles to choose from. And remember, when it comes to investment styles, there's no one size fits all. And you can take a little bit of each style that works for you within your risk tolerance and your goals. And now that we've gone through some of the basics, in the next episode, I'll take you through how to find a broker and actually make that first purchase. I really hope you've enjoyed the content so far, and hopefully you've been able to take something away from each of the episodes and start to put together a bit of a risk profile for yourself and a plan and what type of investor you'd like to be. And as always, if you like what you heard today, please hit that subscribe button or leave me a review. I'll leave you with today's closing quote, which is from Charlie Munger, who once said, "Spend each day trying to be a little wiser than you were when you woke up." You know, there's always something new to learn, either through experiences, reading, or just listening. So hopefully this podcast has helped you become a little wiser today. Thanks very much, guys, and have a good week.
Please remember, the information and opinions provided in this podcast is general advice only and does not constitute financial advice. This podcast was created without knowing individuals' needs, financial situations, or investment objectives. The host of this show may hold positions in the companies discussed. Please remember, before considering any investment, please read the product disclosure statement and consider speaking to a licensed financial professional.